The fight against inflation in Australia has been a long one. Rates have been cut in New Zealand, Australia and Canada, but here they remain stubbornly high. Everyone is feeling the pain of higher inflation when we go to the supermarket, go on holiday, or even get a local cup of coffee. Everything is more expensive. The main weapon the Reserve Bank of Australia has against inflation is interest rates. But that has collateral damage, and that's mortgage holders, anyone with a loan to the bank. Everyone is feeling the pain at the moment. Economists point to a number of reasons why inflation is stubbornly high in Australia. One reason is that employment is relatively high in Australia. That means people have jobs and they have money to spend. Another reason is the falling Australian dollar, making the price of imported goods more expensive. A key measure of inflation is something called the Consumer Price Index. Put simply, the CPI is a measure of the average change in the price of a basket of goods that we buy on a daily basis, whether that be vegetables, bread, clothes or a visit to the doctor. It erodes the purchasing power of our money. Over the long term, rising inflation is actually a good sign. It shows the economy is growing. If inflation is too high, particularly when wages haven't also increased, it can become a problem. The RBA wants inflation to be between 2 and 3%, rather than the current 3.2 to 3.5%. It's just too high at the moment. The return of inflation to that target below 3% will not only be good for Australians battling cost of living pressures and mortgage increases, it will also be a crucial cog in the re-election chances of Anthony Albanese.